Well, Janet and I decided that it would be much better for her to give her professional opinions. She's been involved in this conference for a very long time. So she will provide 15 minutes of comments, followed by my 15 minutes, followed by 15 minutes of questions from people there in the actual or virtual audience. So Janet, please go ahead.
Thank you, Mark. I'm going to try to keep time here. My name is Janet Garufis. I'm the chairman and CEO of Montecito Bank and Trust, a $2.5 billion community bank headquartered in Santa Barbara County. We have lots of experience in making these kinds of loans. My background, I spent half of my career in systemically risky banks and the other half doing community banking. So I have this kind of unique perspective. I've also have a PhD, and so I come at this with both a researcher's lens as well as a banker's lens. And so these have been very interesting papers. And I had the opportunity to visit with Mark and the three presenters today prior to this. And it was very clear to me that there is an awful lot to a researcher that is just invisible to them in the data. And so we talked a little bit about that earlier, but let me just share with you a few of the observations that I had based on that comments. So first of all, well, I guess I'll start with, let me start with Amanda. I guess that's probably the best way to do it. So Amanda says that, and I absolutely agree with Amanda from my personal experience in construction lending, that the more you monitor, the less default you have. But there are a lot of other contexts that have to be evaluated in that. So when we go to, let me just go to my notes here. I'm sorry. Here we go. One of the things that occurred to me when I was listening to Amanda's presentation is she talks about the timing, like that some draws, some monitoring happens sooner rather than later. There are more monitoring events on bigger loans. I would tell you that the type of loan, there are a lot of different kinds of construction loans, a lot of different types of properties. And whether or not there's a draw in the beginning for land or not would make a difference about when that first draw happens. And the type of complexity of the construction loan would have a whole lot to do with how many of those draws would happen as well. So the other issue that I saw that I thought was really interesting is, there was a comment about, is the property closer to the branch or farther away from the branch? And what that made me think of is the organizational design of this particular bank. If there is centralized approvals for these types of monitoring, if the loan officer has the approval to decide when the thing gets monitored or when they do it, it could have a whole lot to do with the lender's workload. And so if the lender is backed up and they can't get it processed quickly, they may just waive it if it's within their authority to do so, or if, as Amanda says, they have a great relationship with the contractor or with the borrower. So I thought those were really interesting thoughts about the things that couldn't be seen from Amanda's perspective in the data. The other thing is that was not discussed. There's a comment in the paper about, at the time of loan origination, the borrower and the bank work together to produce an estimate of value. Today, that doesn't happen. There are appraisals. The appraisal rules have changed a lot since the Great Recession, and the borrower has nothing to do with that appraisal, and the bank has total control over it. Not only does the bank have control over it, the lender may not have anything to do with ordering the appraisal. So there's a real check and balance around the actual estimated value of that property when it's completed. And so I think that there was a statement about it's possible that a higher valuation and a lower loan to value may have something to do with reduced numbers of monitoring events. But in my experience, I would be surprised if that were the case. I think it probably has a whole lot more to do with who's responsible for ordering these monitoring these monitoring events and who has the responsibility to approve them and approve the draws. So I thought the paper was really well positioned. I'm very excited to share this with my construction lending team. I think they will learn a lot from it. With respect to Greg's bank loan markups, I was really interested in this because these are large banks, much larger banks than I operate today, but banks that I did used to work in. And one of the things that I think should be considered, but would be invisible to Mark in his data, would have to do with the competition in the marketplace between the lenders who are out looking for these new relationships and who are probably well incented. It might be a big part of their total compensation to bring in a new borrower to the bank. And so incentive compensation drives a lot of the activity about bringing in customers, and ultimately, depending on how much influence the lender has in setting the price for the loan, it could have a lot to do with that. The other thing, it could have a lot to do with it in both directions. If the lender is incented and they're getting to a point in their quarter or the year where they haven't reached their goal, they may be highly incented to reduce a price to get a borrower to say yes. The other thing about that is that if the lender has a relationship and they are incented for retention of those relationships, they're likely not going to reduce the price as much unless they're getting pushback from the borrower. But a borrower will stay with the bank because when something bad happens, if they have a relationship, they can go right to that borrower and get what they need to resolve the situation. If they had to go to a new lender, they would have to go through all of the process of giving them their information, having it underwritten, and that would be really a challenge. I will just also say, with respect to the pricing, one of the things that I saw in Greg's presentation about his assumption about the cost, he says that cost is equal to marginal risk plus the markup. And one of the things I did not see in that, and it may be implicit and I just don't know, is there's a cost to originate that loan that doesn't seem to be considered in this evaluation. It's somewhere in between the marginal risk cost, because there is definitely the risk, but there is a significant piece of cost to originate, which includes the cost of funds just to book the loan, and as well as the cost of the underwriters and the servicing of that loan. And I don't know if that was considered or not, but that would be something to think about for maybe a future paper. And then finally, for Daniel, Daniel and I actually had the chance to talk about PPP. One of my experiences with PPP as a community lender is that when I read Daniel's paper, it felt like a tale of two kinds of banks. The big banks that Daniel is referring to absolutely turned away their small borrowers in favor of their large relationships. And all of those small borrowers came to community banks, at least in our area, in our experience, because they could not get their bank to return their call. And I think it was just the nature of the beast. I don't know why. And I think Daniel's assumption that it may have something to do with risk of default, trying to mitigate that, could be a very real thing. But certainly the community banks benefited. Those of us who did PPP loans ended up being the largest PPP lenders in our geographies when we're in more rural or less metropolitan geographies, larger than the major banks, because we were doing by number a lot of loans to smaller businesses, certainly much smaller than these. I think the largest loan that we did was probably $4 million. So, but that was by far an outlier. So I thought that Daniel's study was really intriguing, and I would love to have him go back and look at what happened on the community banking side, because I think it's a very different experience. And again, it's invisible. It's the kind of thing the data would not tell you unless you spoke to people about what was their experience doing this. One of the things that I was intrigued by in this study had to do with the idea that relationship lenders were more likely to violate the PPP rules, like numbers of employees. Now, in those very large loans, it's possible that that's true, but for the loans that we were doing, the numbers of employees were self-reported, and it wasn't something that you had to necessarily validate. So a lot of the data that we got, we found that borrowers knew exactly as the program went on, especially when you got to the second phase of it. Borrowers had sussed out, if they had either a CPA who was helping them, they'd sussed out what it was that they needed to write down on that piece of paper to get that PPP loan. And because they had missed the first tranche, some of them had missed the first tranche, they were really, really intent upon making sure they got some kind of funding. So that was an interesting and curious thing for I thought him to find. And I'd love to know more about what you would find if you went and did a study of, say, the community banking, the lower end of the PPP scale, and what that experience was like, because I imagine you would find that things were different. So those are my comments. I'm happy to answer any questions. I do love what Amanda said, is to ask the audience, if you know something and you can share it with her, she would really appreciate it. And I think that's the idea of this invisible data, this invisible knowledge that we have as practitioners in the industry. We see what happens. We've been doing it for a long period of time. And so we do have a different set of sort of contextual data that may not be evident to the researchers. But congratulations to the researchers, job well done. And thank you so much for including me.